Welcome to the Investment Opportunities in a Negative Yield Environment webinar. We're going to get started. If you guys who are live could just send a message in the chat about the video and sound quality, that would be much appreciated. And I'm going to go ahead and share the screen, and we're going to start. So bear with me here. I'm going to share the screen so that you guys can see the presentation. And here we go. All right, so hopefully everyone can see and hear, and we're going to begin. All right, so for those of you who don't know me, my name is Gary Mishuris. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the FW Olin Graduate School of Business. I'm not going to spend too much time on myself. A little bit about Silver Ring. It's a concentrated value partnership where there's a very strong alignment of interests. It's competitive advantage is a long-term time horizon, a microeconomic focus, a very even temperament, and a limited asset base to be able to take advantage of inefficiencies in the markets. I won't spend too much time on investment philosophy, but it's a very intrinsic value oriented with a strong focus on the margin of safety. And I'm going to jump into the webinar, which is what you guys are here for, and stop talking about myself. So basically, I just want to get a disclaimer out up front that what follows is not a set of forecasts or recommendations. I always put this in the back, but I think this time that it's worthwhile mentioning it up front because sometimes people misconstrue it. I think that actually, for a professional like myself, giving specific recommendations in a public forum is probably not the most helpful thing for you guys. So rather, what I wanted to do is conduct a thought exercise on the possible implications of the current very low interest rate environment, and also suggest some potential areas of opportunity that you guys then could pursue. But I'll try to be somewhat specific, at least to send you in the right direction of what I'm thinking, where the opportunities might be. So let's get in this. So I guess first of all, here's the current yield environment. U.S. This is last week. The 10-year bond yields were 1.8%, all the way down to Switzerland. They were negative 0.5%. So we're somewhere between very low to negative rate environment in most markets. So next, if we go ahead and look at the history of this is U.S. yields, the history is that this is pretty extreme environment, and it's been extreme for a few years. So the average has been about 6% for U.S. 10-year government bond yields, and a high of 15% plus. So less than 2% is pretty extreme. And this is the U.S. equity environment over the same period from the early 60s until now. And you can see that from 1962 until present, so the same environment when the 10-year bond produced a 6% annual rate of return, U.S. equities produced about a 10% annual rate of return, or about a 4% excess return over the 10-year bonds. So let's use that information and kind of construct a what kind of a valuation based on a discounted cash flow methodology for the markets. And basically, what we try and do here is try to do a fundamental cash flow based valuation. And we're saying, let's say we're going to have a period of above average growth, and it usually has been about 6%. Because we're growing, not every dollar of earnings converts into free cash flow because we need some money to support that growth for working capital and so forth. And let's say that abnormal growth stage lasts 5 years. And after that, the growth rate decelerates to 3% and stays there. And historically, let's use that 10% long-term return on the market that I just showed you as the discount rate. And you get that a dollar of earnings is worth $15 in that scenario, meaning that it implies a forward price to earning ratio, or PE, of 15 times earnings. And if we look at where has the market actually been over that period of time, it's been pretty consistent with that. And by the way, I didn't data mine this and reverse engineer it to line it up. I just started from first principles, and it comes out pretty close. So the average over this 50, 60-year period is about 16 times trailing earnings, which is very consistent with 15 times forward earnings. So let's go ahead and take a look what growth implies. Higher growth obviously all else equal, implies a higher valuation. So here is that 15 times earnings for our normal default market scenario. So for a company that's growing above that, you're going to have valuation that should be higher. And for a company that's growing below that or shrinking, the valuation should be negative. That's pretty, common sense, I would say. Hopefully that that makes sense to everyone. So all right, so that's not that interesting. We know that. What about if we take a look at the duration of growth? And what I mean by duration of growth is, rather than changing the growth rate, we're going to change the length of that first period of growth where we're growing above 3%. So here in the leftmost column, we have the old market 15 times earnings valuation. Now we increase the growth rate from 6% during that first 5 years to 9%, and we get only 17 times earnings. So it's higher, but it's not drastically higher. What about if we keep that growth rate constant at 9% and increase the length of that first growth stage? So we've got 5 years, 10 years, 15 years, 20 years, 25 years. What I want you to notice is that valuation increases drastically. So, in the extreme, you have, when you have a 25-year first stage of abnormal growth and decelerating to 3%, you're going to have $1 of earnings worth 27 times as opposed to 15. So a very big difference. Now, let's go back to the kind of the current rate environment for a second. So historical bond yields have been about 6% in the US. Average S&P returns over that period have been about 10%. So, defining the equity, quote unquote, risk premium as the difference between the two, we have about 4.1%. And if we were to superimpose that risk premium on top of the current yields, we would have an implied equity discount rate right now of just under 6%. So, if that spread were to hold constant, instead of 10%, in theory, we should be using 6%. By the way, I'm not saying that that's right. I'm just saying that if, again, this is a thought experiment. Let's say that the bond markets are right and these rates are here to stay, and that, equity should have a similar premium versus bonds. This is what this would imply. By the way, Europe and Japan would have even lower discount rates. So let's take a look. What would that mean if we hold on to the rest of the assumptions? So here is a gray column. 15 times earnings are old assumptions, a 10% discount rate. Now we're holding everything else constant, and we're changing the discount rate. So if we change the discount rate, earning $1 of earnings of 15 times earnings should be worth maybe 30 plus times earnings, right? And that's actually much higher than the current market valuations. By the way, I'm a value investor. I am very well aware that the stock markets, at least in the US, have been running up for years. And here we are. US stock markets are about 20 times forward earnings estimates. Japan is at 15 times. Germany is at 19 times. And that's actually way lower than is implied by this math of, if we were to decide to lower the discount rate based on the bond rates being very low. Interesting. You might say, wait, interest rates are low because expectations for growth are so low. And that might mean that we don't want to, we shouldn't keep that first stage of growth, at 6% because that's too high. It's okay. Let's go with that and let's change that 6% right down to 3. And then the market P at our old assumptions should be 13 times, but we can, at 6%, it should be 29 times, still much higher than where the markets are today. By the way, so let me be clear. I'm not saying that the markets are really undervalued or something like that. What I am saying is that there is a pretty meaningful inconsistency between the bond markets and the equity markets, meaning that the equity markets are not quite as expensive as they would be if the bond market rates are going to be correct long term. So implication number one of the low or no or negative yield environment is that if the bond markets are correct, equity valuations are actually too low. So again, I'm not predicting that the stock markets are going to go up or anything like that. So I want to be clear. All I'm saying is that there's a pretty strong inconsistency between the two, which is interesting, especially since most of us perceive the market as fairly expensive and having run up for quite some time. Let's put aside the market because I'm a microeconomic driven bottom-up value investor, and let's think about where should we be looking for opportunities in terms of undervalued securities in this new normal environment, if it is indeed the new normal. So let's go through some assumptions. Let's say that rather than instead of 10% discount rate in the U.S., we're going to use a 7% discount rate. That's actually a little bit higher than the 6%, but it's would imply a 5% equity risk premium over the current bonds. And let's go ahead and look for where the areas of opportunity might be. All right, so we have here is a valuation versus growth rate chart, the same one we had last time, except now we're adding a second set of rows for the new 7% discount rate. So let's see what it means. So that yellow row at the bottom shows you the change in valuation between the old assumptions and the new ones. And if you notice that the left side increases much less than the right side. So what does that mean? Well, that means that the higher growth companies increase in value much more than the low or no growth companies do. All right, and I think that's interesting because perhaps that's partly what's contributed to the last 5 to 10 years of value quote unquote results being underwhelming compared to the market or the growth investing. And this makes sense, right? If you think about equities as set of cash flows like bonds with variable coupons, then the higher the growth rate, the more of those coupons comes from the future or the distant future, and the more change in the discount rate would affect the value, right? Okay, so let's keep going. All right, what about if we change the duration of growth? So now we're keeping the growth rate constant for a second, and we're seeing how in this new 7% discount rate equity market, how the values change. So the leftmost column here is the old market setup, 15 times earnings. The next column is instead of 6%, we're using 9% growth. So 9% is not considered by most investors to be a particularly high growth rate, by the way. So we're not talking about 20% growth or anything like that. This is a high single-digit rate of growth. That's 17 times rate, at the old assumptions. And now we saw that at the new discount rate of 7%, it's 29 times earnings. And then the next four columns, we're increasing that stage, the length of that first stage, from 5 to 10 years, then to 15, then to 20, and then to 25. So look at what's happening. The duration of growth has a huge impact on the increase of value, to the point where if the growth is going to persist at 9% for 20 or 25 years, then $1 of earnings is actually worth 50 to 60 times earnings. And that's a pretty interesting conclusion. The way, again, this makes intuitive sense, because what this is telling you is that, again, the further out the center of mass of those cash flows are, the more that lowering the discount rate is going to increase the value. That, again, makes intuitive sense, and that's correct. By the way, that the increase in the duration of growth actually has a bigger impact than keeping that 5-year first stage growth rate, growth length, and then increasing the rate of growth. So the implication number 2 of low or negative yield environments is that if, and this is an if, interest rates remain at current rates, then equities that increase in value the most are those with a long duration of above average growth. By the way, this is actually not what most people are looking for as far as high growth companies. And that's why I think that they might be, kind of mispriced or hidden opportunities, because when Wall Street analysts or investors in general are looking for growth companies, they just don't typically find high single digit rates of growth that sexy. They want 10, 15, 20% growth, right? And that's what we've seen a lot of these unicorns come that lose money, but they're growing. And, if you're not growing 15, 20%, then, oh my gosh, you're not a growth company anymore. So we're talking about companies that are growing 8, 9%. And what we're saying is we want to find the ones that are going to grow at those rates for a very long period of time, because A, that's underappreciated by the market potentially, and B, that's especially going to be valuable in a lower rate environment if that environment is here to stay. So where and how can we find such companies? So first of all, really high growth rates are hard to sustain. And second, really big companies might have trouble growing at really high rates, or even at above average rates for a really long time. And so, growing at above average rate for a long period of time typically requires that the company have a strong competitive advantage, and that its industry is not susceptible to material adverse changes in economics, right? And then, where should we look? So a good place to start might be companies that have already exhibited above average growth for some time, and also have above average returns on invested capital or returns on equity, because that might be a sign that they have a competitive advantage or favorable industry economics, but yet they're not too big. They haven't reached that critical mass where they just, by virtue of their size, can't sustain that growth rate. So remember, a moderately above average growth rate for a long time is very valuable, and most market participants aren't focused on that. So here's a quick screen I put together in Bloomberg, and I'm gonna just show you. So this is basically all U.S. companies that we're starting with. I'm gonna restrict it to companies with a market cap of above 25 million and less than 50 billion. 25 million is just to make them investable at reasonable scale. And less than 50 billion is to keep out the really, really big mega cap companies where that historical growth rate might no longer be sustainable. And next, we're going to say, well, let's find some companies that were able to grow at high single digits rates or higher through the last recession and in the last 5 years. And also, during both of those periods, we want companies that have had above average return on equity. So I'm just saying return on equity on average over each of those 2 5-year periods at 12% or higher. So what I'm trying to say is we want companies that grew through the last cycle, because we don't want to have companies that just grew in the last 5 years, but maybe it's because they're cyclical companies and we're in the expansionary part of the market. And so basically are potentially, catching ones that don't have sustainable growth. So these companies have grown for a long time at above average rates and grew through a recession and have above average returns on equity. And only 89 companies passed the screen, which out of a universe of about 4,000 companies or so. So that's a pretty small percentage. That's 2.5% or something like that. So that's interesting, right? That even using relatively low growth rates of 8%, which is not something that, again, most people would identify as particularly high, you get such a drastic reduction in the universe that it might point you in a direction where some of these companies are hiding. So here are some of these companies in the screen. Again, I just want to be clear, I'm not recommending these companies. I'm not saying that these are good investments. I think you need to do your own fundamental analysis and valuation to figure out which, if any of them, will remain above average growers and which, if any of them, are undervalued. This is the second "don't sue me" slide. But it's interesting. A number of these companies, if you look at the right column, are not particularly expensive, meaning it's not like they're trading at astronomical valuations of their earnings, meaning that maybe they've already been discovered and fully appreciated. So it's an interesting area of opportunity. I think there are other ways to kind of search for this as well, but I think that at the very least, this is a direction for you to pursue where, again, if I were to summarize the conclusions here, is implication of low yield. Number one is that if the bond markets are correct, equity valuations are actually too low, which is a counterintuitive, at least to me, implication. Because going into this exercise, I actually had this, feeling/belief that the equity markets are actually pretty high, and they are, but they're not quite as high as the bond market. So, obviously, the inverse of that is maybe the bond markets are crazy and there's a huge credit bubble happening, and that's definitely a possibility, by the way. But I'm just saying that there's an inconsistency between the two. And then implication number two is that if interest rates do remain at their current rates, then equities that increase in value the most are actually those with a long duration of above average growth. And many of these companies are not the market's darlings with astronomical valuations, and they might present, at least some of them, might present attractive long-term investment opportunities. There are obviously multiple ways to find such companies. Screening is one. Another is just deep knowledge of specific industries and companies. If you have a watch list of basically companies that to be above average growing businesses, and primary research, talking to people. Warren Buffett, I think, used to say, ask when he was younger and did a lot more primary research, he would ask each of the CEOs he would talk with, he would say, well, if you had to put all your money in one of your competitors for 10 years and you were to go on a desert island and you couldn't touch that money for 10 years, which company would you put it with, right? So that's a good question, right? It basically gets the CEOs that you're talking with to give you, their best competitor, but not best from a, oh, they're doing really well right now, but best from, wow, these people might, be, really good for the long term. And by the way, if they say, I wouldn't give it to any of my competitors, well, maybe they're just, don't like to complement their competitors, or maybe they basically are, just saying none of this is not a very good industry, right? So anyway, so these are some conclusions. I'm going to open up to questions in a second. So please, if you're listening to this live, please start, submitting questions, and I'll go through them in the order received in the chat. This is again the don't sue me slide. Also be happy to send my owner's manual where I describe my actual full investment process in more detail if you guys send me an email. And that's about it. So I'm going to start looking at the questions. If there are no questions, then you guys will get to enjoy your lunch early. If there are questions, I will be happy to try my best to answer them. And actually, as you guys are submitting questions, one company that, so when I started investing, it was almost 20 years ago, and I was my first job was an equity research associate at Fidelity, and I was following the specialty chemicals industry. And I was a very much of a Ben Graham style value investor, and so I wanted cheap stocks, cheap securities. That was my area. And there was one company that was always the most expensive company in that space, and that company was Ecolab. The ticker is ECL. It's a Midwest-based company. They do cleaning chemicals. It doesn't sound very sexy. It's a low growth, mature industry. There's a lot of competitors, so forth and so on. But they were very good at what they did. They had created very strong competitive advantages, and they were organically growing about 5-6%, and on the earnings line, 10% plus organically. But they were trading at 23 times earnings. And I looked at it and said, you know what, guys, it's too expensive. It's not worth it. So interestingly enough, when I go back and categorize my many mistakes, that company is so much bigger and better today than any of the other companies that I followed. And if I compare that company starting at this high valuation of 23 times earnings versus the cheap stocks that I found, Ecolab did so much better. I don't think the lesson necessarily is to buy expensive stocks. The lesson is if you find a really good business with a strong competitive advantage, a good management team, and a long-term above average duration of growth, that is very valuable. And so you should, if you find a company like that you can understand, and I think, we can all get our arms around cleaning chemicals, then, that's the kind of company you might want to consider, especially since it's going to be much more valuable in a low rate environment than in a high rate environment. All right, I'm going to go through some questions. All right, first question, I'm just going to read it out loud. Could this inconsistency of us believing that the market still has room to grow based off these assumptions be more of an example of reflexivity? Well, so the reflexivity is a concept that Soros introduced, and the idea of reflexivity is that higher prices beget higher prices. So an example might be, let's say you're a conglomerate, and you use your stock as a currency to buy other companies, and let's say a stock goes up and the valuation is high. You use that to buy cheaper companies using that stock. That gives you more earnings. That your stock goes up further. People now give you credit for even higher growth rate. Your valuation expands, and it feeds itself, right? It's not reflexivity so much in my view as relativity. And I'm an absolute value investor. I'm not a relative value investor. And just so people are clear, I am not lowering my discount rate. At Silver Ring Value Partners, when I'm making an investment, I am demanding a minimum of a 12% rate of return, which, by the way, that's my intent. That doesn't mean that I'm going to get in every single investment. I'm going to make mistakes, but I'm not intentionally lowering the bar. However, I'm just saying that if you were to look at the various assets out there, of the assets available, equities are relatively cheaper. Now, does that so I don't know if there's necessarily a reflexive loop between equities and bonds. What there is there's a very somewhat irrational. I mean, by the way, I think I do think the credit markets are in a bubble, especially in negative rates, because how can it make logical sense to invest money if you're giving $100 with expecting positive inflation, which most of those people in those countries do, let's say Switzerland, and then you are giving it intentionally and you plan to receive $90 in 10 years. That's not investing. Investing, by definition, is laying out money today on the reasonable expectation of receiving greater purchasing power in the future. So I think there is a bubble in parts of the credit market, but I'm not. That's part of the reason I don't think necessarily this is the long term. But we have 30-year bonds in the U.S. are about 2%. So clearly, the rate structure of the credit market suggests that the market believes that it's permanent. All right, next question. Which is your portfolio target growth rate over a period of 10 years? I don't have a growth rate target. I'm happy buying companies of all rates of growth. My criteria really is, do I understand the business? Can I approximately value it in a tight enough range for it to be useful? And then can I buy it with a very large margin of safety? I think my style personally is I probably don't have too many really high growth rate companies because I'm not willing to pay up, astronomical valuations and make a bet that I'm good enough predictor of the long-term future to buy a company that's being valued by the market as if it's a, say, 15% growth business, believing it's a 20% growth business. So I would say that I think on average, my portfolio has average growth rates, with some companies that maybe might not grow at all, but are really, really cheap, and other companies that are growing, at 5, 6, 7, 8%. But that's because of where I see opportunities. If I saw opportunities in high growth companies, I would basically be happy to examine them as well, as long as they fit my qualitative and quantitative criteria. Okay, so next question is, hello, are banks good investments in this environment? They seem to be well capitalized. The honest answer is I don't know. I've tried investing in banks in the past. I find I'm not particularly good. I know people who are, so I'm not saying it's not doable. I just realized that for the time being, at least, it's outside of my circle of competence. So I think rather than kind of make something up, I'm just going to be honest and tell you I don't know. I know I have friends who think that their banks are good investments in this environment, but I don't have anything useful to add, unfortunately. Okay, next question. What are the best areas to invest in low interest environment? Well, I think that I mentioned some, so hopefully that was addressed during the presentation. All right, next question. Do we need to adjust the ROE for companies in different industries, adjusting for leverage of balance sheet liabilities and so forth? Any quick rules of thumb that have served you well? That's a good question, because I think that obviously if the ROE, or return on equity, is based on a unsustainably high leverage, it's not necessarily representative of the underlying economics of the business, because you're taking on bankruptcy risk essentially. So I use ROE in the screen because it's quick and it's easier, it's more available. But when I look for validation, for quantitative validation of company quality, I look at return on invested capital much more than ROE for most companies. I think that if a company is over-levered, you do need to adjust somehow, because you have to think like a private owner. If you were to buy the whole business and just own it, those cash flows, and the company were over-levered, whether it was on balance sheet or off balance sheet, then I think what you would need to do is deploy the first portion of the cash flow stream to reduce the leverage. So I think that you definitely need to take excess leverage into account. And I think that return on invested capital adjusts for that. Okay, so next question. Hi, Gary. Neil here from Germany. Welcome, Neil. Are there any sectors, industries you would look at specifically within the broader market? I don't know if there is some kind of a theme. So I'm not a thematic investor. I'm much more of a bottom-up investor. So I don't. So I'm sorry to disappoint, Neil. I don't have necessarily a specific industry. I think the kind of industry you would want is you would want a industry where the rate of change is moderate. Because I think if you have an industry where, for instance, market share changes drastically, like consumer electronics, where 1 year someone has 30% share and then someone else comes out with a better gizmo and all of a sudden they have 10% share, then those economics don't lend themselves to predicting the long-term economics of the business that you need to value it. So we want an industry, I think, where the rate of change is fairly moderate. So I gave an example of clean chemicals, and you would say, well, but that's not a cyclically growth industry. So again, I would pull up Ecolab and see how it did versus the market over the last 15, 20 years. There are companies that are in boring industries, but that have a competitive advantage that can do quite well for very long periods of time. So I'm focused much more on companies and industries, but I want industries where they're pretty decent businesses on average, rather than finding necessarily the few exceptions in a very tough industry. Okay, so next question is, what is the average P ratio and average EPS growth rate of your portfolio? So again, similar question. So I think I talked about average EPS growth rate being roughly average, probably mid-single 4 or 5% if I had to guess. I don't have the exact number in front of me. My average P ratio is about, I think, 9 times earnings. So that's part of the reason I'm personally excited about the very small. Again, look, I have a dozen. That's 12-ish, not 1,000, a dozen investments or so. So I've been able to find companies that I feel are very much undervalued, and that's why I'm excited about their prospects relative to their price. But that's not at all representative of the broader market. And actually, I've been focusing on trying to find the next set of companies which, to invest in additional capital as it comes in, or to invest in capital as some of my current investments, hopefully work out, and then price to value gap closes. And it's hard to find new opportunities right now, at least based on my criteria, where I'm not lowering the discount rate. And that's why this is an interesting thought exercise, because should we not? There are some value investors that have lowered the bar, and they said, look, in a 2% 10-year bond environment, it's crazy to use all discount rates. Maybe, but I believe that things mean revert over time. I don't know when. Obviously, this has persisted for far longer than I would have thought. But if I'm going to make a mistake, and there are two mistakes I can make. One is I will make an investment at the lower discount rates, and it turns out that that's wrong, and I lose money. Versus the other mistake is I don't make the investment, and it turns out I'm wrong, and I should have, and I miss out an opportunity. I would rather err on mistakes of omission, but not losing our capital, rather than mistakes on commission, and then if I'm wrong, losing capital. That's just my preference. Most of my capital, my family's capital, is in the partnership that I manage, so I don't fool around, and I'm very upfront with my partners that I'm going to err on preserving capital rather than reaching for every last unit of returns. Plus, I manage a small amount of capital, so there are opportunities, even in this environment, I'm able to find that are relatively idiosyncratic, that meaning that they're not based on the market or anything like that. So I don't feel the need to lower the bar. So next question is, what are your views on ROE versus a return, ROCE, which I'm assuming is return on capital employed? So I talked about that. I think return on capital is a better metric of how good a business it is. And maybe to expand within that, there's two ways to think about return on capital. There's the overall return on capital, and then there's return on tangible capital. And that's kind of what Buffett talks about in terms of measuring the quality of the business. The reason return on tangible capital is interesting is return on tangible capital informs your view on how good the business is. Return overall capital combines that plus management's capital allocation. So imagine that if you started a company and that company bought Coca-Cola for $1 trillion, right? Your return on tangible capital would be very high because Coca-Cola is a good business. But your return overall capital would be pretty low because you paid a very high price, meaning that your capital allocation was poor, even though you allocated money to a good business. So I think both of those metrics are helpful and tell you different things. Next question. Gary, thanks. You're welcome. All things being equal, which they're not, given that the U.S. bond market and maybe the world has had its greatest historical 30-year run, maybe even getting close to equaling average S&P returns over the same period, why would any fundamental, not technical investor purchase a bond at such an expensive rate? That is an excellent question. I have no idea, but I will tell you, a perspective of a friend who shall remain anonymous, who has been buying in their portfolio longer duration bonds. And we were having lunch, and I hope if you're listening, I hope you won't take offense. Anything I'm saying here, I've said to that person during a conversation, is that they're doing it because in the short term rates may fall, right? And if rates fall further, the longer duration bonds will go up. And so I said, well, so these are, as the saying goes, they're not eating sardines, they're trading sardines. Meaning you're not doing it because you think that it's a good investment to hold to maturity. You're doing it because you think in the short term there's going to be some kind of a macroeconomic change that's going to lead to a price movement that you expect to make money off of. And he said, yeah. And so that's why you would do it. That's not how I operate. I think about the long term, and when I make investments, I think about what would be the return of the investment if I had to hold this forever. Not that I would. My average holding period tends to be 3 to 5 years, but I make every investment as if the market weren't going to bail me out. So I don't see any reason why you would lend money to the government at 0% real rate of return, or possibly negative if inflation accelerates. So fair question. Next, hi Gary, how long do you expect this negative yield environment to continue in the future? And for your portfolio, have you accounted for the fact that negative yield environment might not be sustainable for long? If that happens, how would it affect your current investments? Right. So I don't know how long it will persist, because obviously if I knew direction of rates and timing of that, I would be a very, very wealthy man, more wealth than I'm already. And it's not my area of expertise. Again, I'm a microeconomics investor where I'm focusing on bottom-up analysis much more so than macro, which I know very little about. So I don't know the answer to the first question. And I think that I have accounted for this environment not being sustainable, but by not lowering the bar. So what I'm doing is I am keeping my required rates of return high, even though the current environment might suggest they should be lower, but exactly because I don't want to lose money. And I'm working really hard to find ideas that are attractive, even at those higher discount rates, because I think that's the right way to think about managing risk and obtaining the right margin of safety. I personally would not be comfortable making investments that are only good investments if this rate environment persists, because to me, I don't see a reason why it should. But then again, people can point to countries like Japan, where rates have stayed near zero for decades. So anything is possible. I'm going to try to focus on microeconomic driven mispricing, and that's where my circle of competence is strongest, and I'm going to do my best. All right, next question is, hi Gary, thanks for the webinar. Of course, you're welcome. Any views on the auto sector? Well, the auto sector is fairly cheap on a statistical basis. However, those earnings are clearly at or near cyclical highs, right? And so very smart investors like David Greenblatt David Einhorn, have made big investments in companies like GM. I've covered cyclical companies for almost 2 decades, and early in my career, I always remembered hearing myself telling more senior investors, "Oh, it's cheap enough. All the cyclical issues are discounted. Yeah, I know we're near the cyclical peak right now, but it'll be okay because it's too cheap even on earnings adjusted for where we are in the cycle. Let's say on mid-cycle earnings." I've never ever made money on any of those investments ever. I just think that companies, the problems that companies have almost always get masked by cyclical, benefits and the easy operating environment, and they only get revealed during the recession. I remember reading Joel Greenblatt's notes at Columbia from his class in 2005, 2006, and he invited a very famous value investor who I'm not going to name because there's no point, but he basically in 2006 pitched Lear, the company that makes car seats, as an investment. And he told these Columbia Business School students how wonderful a business it is. It's a duopoly. It's amazing. There are all this specialized knowledge. And people said, well, it's a little bit cyclical. It's where we are in the cycle. Aren't you concerned? He said, no, it's a great business. It's going to do fine. And the outcome, they filed for bankruptcy. Oops. Yeah. So again, and this is a guy who's been doing this for decades, very experienced. And Joel Greenblatt, who's an amazing investor, introduced him as someone who is smarter than him. It's a good friend of his. So investing in cyclicals at or near peak of the cycle is just hard. There are certain interesting companies there, like GM is very cheap, BMW is very cheap. I have not invested in them for that reason, but no, I'm keeping it out of them because I like, areas where there's fear, and there's certainly some amount of fear in those prices already. So next question, what about foreign companies with valuations that are less pricey or rich? Yeah, so I invest in developed markets. I don't invest in emerging markets because I think it's outside of my circle of competence. I don't know who the crooks are, who the honest people are, but I'll certainly invest, in Australia, continental Europe, and UK, and New Zealand, Canada, and so forth. I need quality, financial statements in English. I need the rule of law, and I want the markets to be the, biggest driver of economics, not governments. And there's probably Europe probably itself is not uniform. That Northern Europe is probably more conducive to that than Southern Europe, but there are exceptions. So I definitely look there. Unfortunately, those markets are also not dirt cheap. They're a little cheaper, but also their structural growth rates are a little bit lower. I've been spending more time recently trying to learn companies in Germany. It's not an area where I've invested in the past, and I think there are a lot of good industrial businesses there. Trying to get to know them better and get comfortable with the business models so that I can invest when the price is right. Initially, I thought that Brexit would cause a lot of fear in the UK valuations, and it has in a few situations, but certainly not across the board. I'm not finding a ton of amazing opportunities in the UK, and so I'm definitely looking there. I'm not necessarily finding great investments there. Although I do have a European company, I have a Canadian company in the portfolio. I have and I've had a UK company in the past. Next question: do you plan to invest in developing economies like China, Hong Kong, Singapore, and India? So the answer is no, not for the time being. I know a lot of people in the value investing community have really been gung ho in China. Charlie Munger has been a big proponent, and that's fine because, well, Charlie has Lilu investing for him, and I think Lilu speaks the language. He understands the culture a lot better than I do. He has relationships there. I would say that for someone like me who's sitting in Boston, it's really not the brightest idea to think that they can easily extend their circle of competence to complete another culture where the government is a lot more involved, where what would be considered fraudulent in the U.S. might just pass as normal business practices in some cases. So that being said, they're probably great businesses. They're certainly high growth rates. I just don't know. In India, the same way. I don't know who's bribing whom, who's doing what, and not to say that there is a crook. It's totally not. There are plenty of legitimate businesses, but business is done differently, and I would be the sucker in the game. So I don't think that I am going to do that. I'm going to leave it to people who have much stronger knowledge bases in those markets. And I just think that there's enough for me to do. I'm a concentrated investor. I have low turnover. I need to find 3 to 4 ideas on average per year. So I don't need to all of a sudden try to invest in areas where my knowledge and my ability to assess a business and management is not particularly strong. Next question is, Gary, do you invest in small microcaps, and how do you adjust for volatility if you do invest in them? So I absolutely invest in small microcaps. I actually am very market cap agnostic. I always, whenever someone says I just manage a large cap fund, just marketing, right? Why are they managing a large cap fund? Because they have too much assets under management, so they can't invest in small microcaps. Conversely, if someone says I only invest in small microcaps, I would say why? And if the answer is, well, they're less efficient, that's true. They're less efficient on average. But if someone gives you a wonderful large cap business, would you not invest because the market cap was over some artificial threshold? That's a silly way to invest. It's really more driven by marketing and how you want to sell your product and how do you want to charge fees. I try to have no focus on superficial metrics and a lot of focus on the business quality and important investment metrics. So in my portfolio right now, I have a company over 100 billion and I have a company under 100 million. And so how do you adjust for volatility? I'm okay with volatility. And I think being okay with volatility by virtue of having a partnership base of investors who are also okay with volatility, because I've communicated to them that that's how it's going to be, I think it gives me a competitive advantage to make investments that might not be the smoothest path, but that might over time, if I do my work well, lead to the highest risk-adjusted returns. So I'm very comfortable with the short-term volatility. I understand that my 100 million microcap, if there's a big market sell-off tomorrow, it's going to sell off more than an equivalent large cap company for no fundamental reason. And you know what? I'll buy more of it. And that's total. And I'll be very happy to do it as long as the price to value gap remains large and the business still meets my criteria. So I'm comfortable with volatility. I don't seek it, obviously. I also have a variety of companies in my portfolio, so I think about managing risk a lot. So I would be a little bit less comfortable if I had a whole portfolio of 25 million cap companies, because they would all get decimated at the same time, and I would not necessarily be able to take advantage of the new bargains. But I'm pretty happy with how the portfolio is structured to avoid that. So next question is, hi Gary, do you invest in Africa? And if not, why not? I don't. Same reason I don't invest in China or India. I just don't know enough about local business. I don't know about who's honest, who's a crook. I don't know how the government is gonna, get involved or not get involved in the businesses. And I think that there are people out there who are much more knowledgeable, and I think that they're the right people for that. So it's, by the way, I'm never saying I'm never going to do anything, but I think that I would have to really prove to myself that my circle of competence has widened enough to do this, and that I'm not finding enough opportunities where my knowledge base is strongest. And right now, I don't have the circle of competence expanded in that direction yet, nor do I necessarily think I will in any foreseeable future. Next question: how do you approach management, especially in small microcap cap industries? Well, so I think management is always important. I think the best analogy I can give you is, think of a company as a ship on the river, manned by a crew, right? So or a body of water, I should say. So the body of water represents the industry. It might be the ocean in the storm, or it might be a very quiet pond, right? Or anything in between. The business is the ship. So you might have a little kayak, or you might have a giant cruise ship, and then the crew is the management. So I think that whenever you think about management, you need to think about essentially what how well aligned are they, number one. So their incentives and alignment with you, and how competent are they both operating the business and at capital allocation. And I have another video that I can link to when I post the replay of this, where I talk about this in more depth. But those are the questions: are they competent? And then they going to be competent at making money for you, or trying to steal money from you, or somewhere in the middle, right? And then with respect to microcaps more specifically, I think that it's great to see owner operators, right? Sometimes it's hard to have a large company with a CEO who owns a meaningful portion of the business. But I think that sometimes you find these kind of CEOs who have 15-20% of the business of this 100 or 200 million company, that especially if they have scaled it from the very day one, that right there gives you pretty strong indication of potential competence and alignment. So I love to see that, and I think that's great. I think also management is more accessible, and you can they also don't necessarily have some polished IR person putting up a bunch of spins, so you can pretty quickly get a sense who they are. So this company in Canada that I'm invested in, it's run by a founder CEO. I flew out there, I visited them, I sat down with him, I spoke with him. I feel that there are things I wish he were doing a little differently, but I also feel that he is 110% vested in trying to create the best outcome, and he loves the business. And I really believe that seeing that intrinsic motivation, as well as he has plenty of extrinsic motivation as well, most of his net worth is in the business, is part of what makes me comfortable with investment. All right, so next questions. How do you account for currency risk when investing in other English-speaking countries? It's fair. There was a foreign investment that I made where I did hedge currency, and there was a foreign investment I made where I did not hedge currency. So I invested in the past in a company called Go Ahead Group, which since the investment didn't work out particularly well, I didn't lose money, but didn't make a lot of money. I wrote to my partner and said, didn't go ahead as planned, pun intended. But it was a UK company. It was a bus operator. It was only in the UK, and UK was going through Brexit, which could put potentially large currency impact. And I'm a microeconomic expert. I'm not a macro expert, and I wanted to have the outcome of my investment be driven by microeconomic forces. So in that case, I hedged the pound because I didn't want all my microeconomic insight to get overwhelmed by some political event I had no control over. In another case, so I still invest in a company called Arcades. It's a Dutch company. It's an engineering design company. By the way, I'm not recommending it. It's stocking up quite a bit. I'm just giving you as an example where I did not hedge currencies. And then the reason I did not hedge the currency is that it's a pretty global business. Even though it's domiciled in the Netherlands, it has meaningful portion of the revenue from all over the world. So in that case, it's not that much different from a company that is essentially domiciled in the U.S., trades in the New York Stock Exchange or the Nasdaq, but has a fairly large foreign business. So I don't hedge currencies in that case because I think it's just the cost is too high. It doesn't make sense in that case. Next question is, any books you can recommend on small cap investing? Again, I'm not a fan of I'm still like I have a lot of friends who do just small caps. I'm still waiting for someone to explain this. How is small cap investing different from mid cap investing? There are plenty of good books I can recommend on investing in general, and I think that I have an article I wrote about the best investing books to make you a good investor, and I'll be happy to link to it. It's on my behavioral value investor site if anyone wants to look it up. But it's I teach a value investing seminar based on that sequence of books. It starts with security analysis, then Phil Fisher's Common Stocks and Uncommon Profits, and so forth and so on. I think that mastering those works, and then a lot of experience and ideally some mentorship is the best way to learn. And saying, well, this applies to companies under 3 billion market cap, but if you're 3.1, this doesn't apply. That's silly. I don't think of it that way. Okay, what's the next question is, what is your overall exposure to equities of your total net worth in percentage form, and how have you made this decision? So I'm not a big fan of top-down asset allocation. Most of my family's net worth is in Silver Ring Value Partners. I eat my own cooking for better or for worse. I have some money outside of that. That's basically my college fund for my kids and some retirement funds. Most of that is also in equity, although I do have some cash. So I would say that substantial majority of my capital is in equities. But the way I manage the partnership is I don't have to be fully invested. When I spent 15 years in the mutual fund world, and one of the things that infuriated me the most is this mantra that we're going to be fully invested. Why? Not because that's the best thing to do as an investor, is because, well, we told our clients to do so. Why we tell our clients? Because it's easier to, you don't have to guess in the market. I like to think from first principles, and I like to be an absolute return investor. So if there are not enough investments that meet my criteria for attractive rates of return, I'm just going to wait in cash until I can find something that does. So in the sense that I let my bottom-up opportunity set dictate my capital allocation, as opposed to, the way maybe a typical RIA would say, well, you're 60 years old, you should have X percent bonds, Y% stocks. That doesn't make a lot of sense to me. There are other ways to think about it. I had a webinar previously on how to kind of structure your portfolio so to live off of it. So in that case, you do care about volatility, and I can link to that as well. But it's on my YouTube channel. But basically, you can create a bond letter to cover your expenses for a few years, 3 to 5, so you're never a forced seller, and then have the rest of your money in the highest risk-adjusted return asset. So I wouldn't want to have some kind of RIA like 60-40 allocation where I'm forced to allocate 40% of my capital to really, really low returning bonds. Like, why? Why would I do that? So basically, think about it this way: you can buy the 10-year bond at 1.8%, or you can get almost the same thing in 3-month T-bills. Why would you buy the 10-year bond? Like, give me a good reason. I like the optionality of having money, that if a great opportunity comes. By the way, remember last year in December, the market sold off. Didn't sell off this year, but it doesn't mean it won't sell off next week or next month or next year. So it's nice to have the optionality that cash offers, and you're not giving up that much return, right? So why would I buy 2% bonds instead of 1.8? Almost same rate of return treasury bills. It makes no sense to me. So I would not want to start with this top-down asset allocation. I would want to, think about your own needs for the next few years and make sure you're invested appropriately for that, whatever that means for your situation. But beyond that, I want to invest from first principles where the potential returns adjusted for risks are the highest. Next question: what sector will benefit the most from negative yield environment? So again, I don't necessarily know if I have a sector to give you. I do believe that, as I mentioned earlier in the presentation, it's companies where they have long duration of growth that's above average. So I think that, and that may be unfortunate for like traditional value investors who just buy cheap stocks at low multiples. So I think that companies that are not growing, for instance, and would benefit far less in a low rate environment than companies that are growing high single digits for 15, 20 years. So which sectors? I think I would put that back to you. I think I showed you one way, to look at that. There are other ways. You can use your primary research scuttlebutt approach. You can, think about a whole bunch of different ways. But I think, I don't know if I can give you a specific sector at this point. Next question, probably maybe this one, if there's any more, I'll take one more, but we're coming up on the hour. But so any comments on low PE, high leverage cyclical businesses? Well, so, Charlie Munger always is a big a believer in always inverting. And so he once said, no, the fastest way to lose money is to buy bad businesses run by bad people at, high valuation and high financial leverage, right? So if you have a cyclical business with high leverage, that could be a problem. Now, if you're an expert in analyzing balance sheets and you understand how to assess, company's financial condition, whether it'll be able to meet its covenants for its debt and all that, then this can be fine. But if you're not, I would say stay the heck away from highly cyclical, highly leveraged businesses, because just because they're low PE doesn't mean they can't go bankrupt. You can still lose all your money. By the way, I gave the example of Lear in the last recession, where this really smart guy who had his own investment firm, was saying this is the greatest thing since sliced bread, and he drove it right into Chapter 11. I'm not making fun of him. I'm just saying how even really experienced people can make mistakes with highly leveraged cyclical businesses. So I think if you're going to have a highly leveraged business, it's much better if the nature of the business is not very cyclical, because that means that when the going gets tough, it's much more likely that the cash flows will still be there to a large extent. It won't necessarily trip covenants and so forth. But again, unless you know exactly what you're doing, I would stay away from highly leveraged cyclical businesses. It certainly looks great when you get it right and you look like a hero, but you can also lose your shirt. And I think, maybe I'll end on this since it looks like there's no more questions. I think at least my style of value investing is you always want to have a margin of safety. And that means that you really are comfortable that you're very unlikely to lose your capital, and only then do you reach for return. If you otherwise, you're basically gambling, and I don't think that the stock market is the place for that. All right. Well, thank you guys for listening. If you're listening to this live, thank you for all the questions. I appreciate it. If you're happy holidays to everyone, their families. If you're listening to the replay, if you like this video, please hit like and subscribe to my YouTube channel for similar videos. Take care, guys, and I'll talk to you next year. All right.